Bitcoin has got its own set of fundamental drivers. Store of value, no, it's not one currently. Will it be one day? Possibly. There is a lot of potential for Bitcoin, but at this point in time, I mean, we're talking about a 1.7 trillion market. In reality, Bitcoin is nothing other than a tech stock.
And welcome back to NinjaTrader Live. This week we have returning to the live stream, Brannigan Barrett. Brannigan, how you doing?
Yeah, good. Thanks to you, Tom. Thank you for having me on the show again.
A lot has changed in the 2 weeks that we've seen each other, right?
We're going to talk a lot about Bitcoin and gold today. One is dropped 9% and the other one's up, 25, 30 odd percent, depending on where you measure it from. So
it's funny you say that because Jim and I were talking last week about gold and Bitcoin, and I said that might be a really good pairs trade. When we talk about pairs trades, maybe you're not familiar if you're new to futures trading, but it's really trying to pick two markets that are correlated but oppositely correlated to take advantage of that spread, essentially. And gold and Bitcoin after the election seemed to me, it's like, yeah, this might be that spread trade.
I think it depends how you look at it. I think at the end of the day, both are driven by dollar fundamentals. Bitcoin is very much driven by the risk on theme, whereas gold is very much driven by real rates theme. And that's kind of where I think we have to go today. We have to understand the playbook of Bitcoin and the playbook of gold, because gold is obviously following the playbook, Bitcoin not so much. And I think that's where there's a golden opportunity, pardon the pun, in Bitcoin. I've prepared two playbooks for the viewers, and I kind of want to just share an idea of what their playbook looks like. Obviously, this is a topic for hours of discussion.
When we had talked last, we talked about which would hit the milestone first. As a late comer to the game, Bitcoin, we kind of entered that in the discussion as 100,000 as a target. E-mini, of course, the 6,000 target, gold is the 3,000 target. I was a little surprised, not too surprised, but a little surprised E-mini hit it first. I didn't think that the election results would propel the markets as much as they did in the stock market. So that was kind of me misreading that. But interesting that these reactions were a little bit excessive, I thought, right away. And maybe the market was just waiting for the relief of the election to be over. But, what?
Yeah, I mean,
we can start with gold. What are the gold beats that you're looking at in the playbook you speak of?
For those that are new to gold, gold is very much a boring product, okay? If you've not traded gold for many, many years, it's a market that very seldom moves. But when there are fundamental drivers or very specific fundamental drivers in the market, gold does move. I've listed these in orders of the most sensitive. What is the macroeconomic theme that gold is most sensitive relative to the least sensitive? Okay, you go back to the 70s, and you often hear this now. People talk about how gold is a hedge against inflation. Yeah, sure. In the 70s it was. We had double-digit inflation. You fast forward to post-COVID, we had nearly double-digit inflation, and gold didn't exactly double in price like it did in 74 and 78. So it's not that gold isn't an inflation hedge. It's just that inflation is not the primary driver of the price of gold, okay? To understand the primary driver, I'm actually going to go through the top two, which is real interest rates and inflation expectations, but I'm going to do it with a visual so the users understand it. Now, don't worry too much if this doesn't make absolute sense, okay? It's something you need to go and understand, look at the charts on. But what you've got here, in essence, in the purple is real rates. Okay, think of that as the level of interest rates 12 months from now, subtracting from that where the market thinks inflation will be 12 months from now. Okay, and what you get from that is a real rate. It's effectively the rate you will earn over and above inflation over the course of the next 12 months. Okay, now what you can see in the purple is that it's currently around 1.36% positive real yields. In the orange, then we've got the price of gold. Now, the primary driver of gold has always been the combination of real rates and inflation expectations. How to think about this? If the Federal Reserve sets policy at too loose a stance, okay, so real rates are not high enough, effectively, the market will then push inflation expectations up. As a result, market participants will want to own gold, okay, because it's a hedge against higher inflation expectations. And obviously, the opposite is true. If the Fed sets interest rate or real rates too high, so they push rates far too high that it actually brings inflation down below their 2% target, we then start to see in a high real rate environment, gold sells off, and in a low real rate environment, gold rallies. So that's the construct of what drives gold. But it's not just the absolute level of real rates, is that absolute level capable of controlling inflation expectations? And that's the key to gold, because if you just looked at gold versus inflation expectations, you would see that over the course of the years, we've had really high inflation expectations, yet gold hasn't rallied, okay? Mm-hmm. So it's very, very important that it's all about the medium term. Where is that inflation going to be in the medium term? And ultimately, what is the Fed doing to the level of real rates to control that medium term of inflation expectations? So that's how you need to look at gold. Now, I think to study gold, particularly particularly, you need to go and look, and I've dated this back to 2020 because that's when we saw COVID. The Fed obviously reacted. They cut zero bound. So they drove these real rates all the way to negative levels. You can see we had real rates very, very low. Now, if you just looked at that absolute level, you would have said, well, why didn't gold significant rally in that time? Okay, moreover, when we did start to see that double-digit inflation, why didn't gold significantly rally? Why were we not capable of breaking out to record highs? It was because the Fed began very quickly raising those real rates to stem any potential inflation expectations becoming embedded. Okay, so it's very, very important to understand it's not the absolute level of inflation expectations that matter, rather, what is the level of interest rates right now and what are the implications for inflation expectations because of that level. Right now, what has the Fed said to us? To understand what the Fed's telling us, we need to look at the start of this year. January this year, the Fed told us that inflation expectations are well anchored, and we remember Powell pivoted in December. So what happened was we started to see those real rates drop off, and gold said, well, okay, hang on a sec, you're not yet at 2%. So gold rallied. Moreover, Jan, Feb, March came out. We saw higher than expected inflation. What did Powell say? He said they speed bumps. We'll look past them. Moreover, in March of this year, he also said we no longer expect to get inflation back to 2%. Rather, we think and we accept that we'll only get there in 2026. What did gold do? It said, no, thank you. We're not accepting that. Ultimately, the Fed's job is to maintain a 2% target over the long-term horizon. When the real rates started to rise, gold plateaued out. The market said, okay, fine. If real rates are going to rise, we don't really want to be owning gold. But then later on the year, August, we had Powell flip-flop again. He then signaled to the market that rate cuts were incoming in August at Jackson Hole. As a result, the market said, well, you still don't have that inflation expectations back at target. And gold took off again as those inflation expectations dropped. In other words, the market is signaling to us right now that real rates are not restrictive enough. They're not high enough ultimately to justify or to bring down the level of inflation moving forward. Going out to next year, we have to say to ourselves, well, is this dynamic going to change, or what changes this dynamic? Well, it's simple. If the Fed tells us they're going to pause in December, yeah, you are going to see these real rates effectively respond, and you will see gold respond. And that's exactly what we've seen now post-election. We saw the market price out those rate cuts. Real rates ultimately have been coming off over the course of the last couple of months, and as a result, gold took a little bit of a fright. Why? Because gold's saying, well, look, if the Fed does pause, they don't cut as much as we think. Well, ultimately, we don't really want to own gold in that situation because inflation should ultimately start to taper off again because of those higher rates. Now, I know that sounds like a mouthful, and it is a mouthful. And that's why you've got to go and get this chart up. You've got to try and map out real rates and inflation expectations as well as gold, because that will start to give you an idea of how gold moves with this idea of real rate and inflation expectations. I suspect what's going to happen, we'll get one more cut from the Fed in December. They'll then pause at the January meeting, and should inflation not move down beyond that January meeting, I suspect we could very much be at the end of the rate cut cycle. But again, I say this is just an opinion. It doesn't mean I'm stuck in that view. It means that I will go to January with that sort of mindset, and should they pause, then yes, I think gold is in trouble should they pause as early as January. But right now, nothing suggests they're going to pause. If they cut in December, they are just sending the signal to the market that they want to keep this process of cutting. Inflation is definitely not going to come down in that scenario, and no one's going to give up on those gold longs until that Fed flips towards pauses and perhaps ends the cycle.
What's interesting with that is with the cuts, though, it also makes gold a little bit more attractive because it isn't an interest-bearing asset, right? So gold doesn't spin off any payments as competing investments like interest-bearing investments. Treasuries is the first thing I think of. If those yields start to come down, then you might say, okay, that could buoy the gold market too, right?
Yeah, of course. The idea you're thinking of and pointing out is there is an absolute level of yields, real yields, where investors say, hang on a sec, why would I give up 3% risk-free owning a treasury bond instead of holding gold? We've not been at that level this year, because if you look at this chart, effectively we're rebasing everything to gold here. So I wanted to showcase to you how Bitcoin has performed, because I think there's a bit of a misleading idea that gold is a store of value. That's absolute rubbish. One day it'll be a store of value. It's not a store of value right now. And we'll look at that using an objective chart. But the key chart I want to take away, in the purple, what we've got is US 10-year bonds. If we rebase that to the gold, so if you think of zero line as gold, owning treasury 10-year bonds have massively underperformed gold for the last 4 years. If you think that was in a rate hike cycle, how can bonds be massively underperforming gold in a rate hike cycle? That makes absolutely no sense. Now, the only reason, or the only way that can be true, is that we've not reached an absolute level where it makes sense to own bonds over gold. If 10-year yields were at 10%, fine. No one wants to own gold in that environment, and you'll massively see the long bond outperform gold. Right now, long bonds is very much an underperforming strategy relative to gold over the last 4 years. So yeah, you're right. There is a level of yields where gold struggles, but we've not seen it yet, not in this hiking cycle.
Right. And for those who are new to this kind of charting, I love the comparison charts. There are different ways you can look at the same things. This is actually saying which market has outperformed and which market has underperformed. So it doesn't tell you anything about how gold has done over the last 5 years, 6 years, whatever this time period is. All it's saying is the S&P has outperformed gold by X% and the bonds have underperformed.
We did the same thing with Bitcoin. I mean, let's just talk about Bitcoin. There's the playbook for Bitcoin. Bitcoin has got its own set of fundamental drivers. Store of value, no, it's not one currently. Will it be one day? Possibly. There is a lot of potential for Bitcoin, but at this point in time, I mean, we're talking about a 1.7 trillion market. It's not exactly anywhere near a store of value, and it does not currently showcase the characteristics of a store of value. What is the key driver of Bitcoin? Because I think there's a little bit of a misunderstanding that Bitcoin is this thing you hodl forever. But in reality, Bitcoin is nothing other than a tech stock. That's kind of how you have to think about it. You can see those correlations. I've got this up. It's the NASDAQ in yellow. It's Bitcoin in orange. And you can see that they are near directly correlated. It is effectively just a risk asset. And that's the best way to understand and interpret. Sure, there are other plays, things like dollar devaluation. If we had significant dollar devaluation, fine. I can understand why people want to own Bitcoin. But right now, the best relationship for Bitcoin is effectively the NASDAQ. Now, one thing I want to point out, be aware of, particularly if you're someone that does get influenced heavily by social media. Bitcoin pre-election was trading 62,000. Okay, we gapped up on one of the weekends when one of the polls showcased Trump was doing very, very well. And effectively to date, we're trading, call it 90,000. We've effectively had a 50% rally since Trump started being priced in as being the outright winner. If you go and actually look at 2021 and you study the NASDAQ topping process, that's this little point over here. What you'll notice is we kind of had this rally and then we sort of went sideways for a significant period of time. You can't quite see it over there, but we popped up in November to make a new record high. It was very, very brief, locked everyone in at record highs. And that was the top for the equity markets.
Yeah.
It was the top for Bitcoin as well. Now, if you look at what we've done in the NASDAQ, okay, we've just popped that record highs, sat up there for a day or two, being happy about the election result. We're now back in below that. Keep a very close eye on this because ultimately NASDAQ led that move to the downside. Bitcoin got dragged with it. The outcome of a favorable Republican win is very much in the price of Bitcoin. As much as there are people telling you it's going to $1 million, don't be fooled ultimately. Okay, Bitcoin is driven by risk markets. And I suspect now we are very, very top heavy. Now, unfortunately, Bitcoin's not a natural sell market. It's not something you ever want to naturally be short of. It is a market you can short when technically they're structured to be short, but it's not something you just sit and be like, I want to short it because it's going to go down in the next 3 to 6 months. So right now, I suspect at some point in the next couple of days and weeks, we are going to get a pretty aggressive, nasty sell-off. You're going to need to let that NASDAQ continue its rotation lower if it continues lower. If it doesn't, like I said, Bitcoin is nothing more than a risk asset. So just pointing out that similarity between the topping out process in November 21, very, very eerily similar. Okay.
Yeah.
Yeah, that's a cool chart.
Bitcoin is kind of that tech bros, they call them. It's kind of among that new technology, the blockchain. It kind of fits in with that Silicon Valley attitude, and NASDAQ, of course, reflects that. By the way, a lot of crypto investors did contribute to campaigns quite heavily, more so than they've done in the past. And I think this was maybe the result. All of these stories, you're right, but it's easy to lose this kind of technical charting in all the news you're going to hear.
Okay, so just don't, and I think you nailed it on there, don't lose sight of the objective facts. Can we go to 1 million over the next 100 years? Of course we can. Anything can happen. We can go to 0 as well. The point is trade what you see in front of you. And right now, we've added $1 trillion. We're up 50% since the election. NASDAQ's turning over. And one of the key drivers of Bitcoin is the dollar. Dollar is up a significant amount, and that's not about to change. The consensus trade is long dollar for next year. In that environment, Bitcoin does not outperform. Be holistic, be objective. Don't be sucked into the hype cycle.
One of the interesting things I find about Bitcoin is there's a limited amount of Bitcoin that will ever be mined. I can't recall any futures market where we had the underlying being limited. There's only so much gold in the earth. There's only so much oil, but we're not going to reach that in our lifetime. That just makes me wonder, is that a good thing or a bad thing for the Bitcoin market? If the miners stop mining and there's a limited supply, what does that do to the price? I don't know. I can't get my head around it.
So, the Bitcoin miners now are incentivized to ultimately keep mining it, but at some point the fees will justify them continuing safeguarding the actual blockchain. So when it comes to the actual technical details of it, Yeah, I'm as clueless as the next guy. So I'm not going to be drawn into that. At the end of the day, my job is to trade the price, to understand the key drivers of it. And that's what ultimately matters for me. So,
and I forget who it was, Frank. I think maybe Frank. I'd have to look back, but he said if I can look at it on a chart, he could trade it. He doesn't have to know the ins and outs of everything, right?
yeah,
If he has a chart, he can trade it.
enjoy it while it lasts. I think that's the key takeaway.
Brannigan, it's been fun talking to you as always.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.